Welcome back to FinBot Insights. Today, we're exploring a topic that might just change your perspective on long-term investing. Ever heard the phrase, the market always goes up over time? Let's dive into the paradox of long-term investing. The idea that the stock market will make you rich over time, no matter when you start, was popularized by John J. Raskob in the 1920s. He suggested investing $15 a month into stocks would turn into a fortune over 20 years. Sounds promising, right? But Raskob's timing was unfortunate. His recommendation came right before the 1929 stock market crash. Interestingly, his advice was blamed for contributing to the mania that led to the crash, as people bought stocks at the peak. However, finance professor Jeremy Siegel from Wharton School argues differently. He says even if you invested right before the crash, your investment would still have grown significantly over a 30-year period. But there are critical assumptions in this analysis. First, you need to invest consistently every month, regardless of market conditions. This strategy, known as dollar-cost averaging, means buying more stocks when they're cheaper. Second, Siegel's analysis assumes you never take money out. But if you need to live off your investments? If you had to withdraw during a downturn like the one after 1929, your portfolio could have dwindled significantly. Let's look at some numbers. If you invested $15 in August 1929, by 1949, your investment would be worth half of what it was initially. Even doubling down during the low in 1932 wouldn't have saved you from a loss after 20 years. From 1982 to 1999, the U.S. stock market had an exceptional run, but that period was not the norm. The volatility in stock returns can drastically affect those needing regular income, like endowments or retirees. Take the period from 1962 to 1981. Even with an average annual return of 8%, if you were withdrawing 5% each year to live on, your wealth would barely keep up with inflation. So what does this mean for investors? The market doesn't always go up in a straight line. This is where alternative investments like hedge funds come into play. They offer strategies like short selling to protect against market downturns, reducing volatility while aiming for competitive returns. Long-term investing does work, but it comes with challenges, especially for those needing income. Diversification, understanding market cycles, and perhaps considering alternative investments can be key to managing these risks. Remember, the market doesn't go up forever in a straight line. There's a paradox in long-term investing, and it's worth understanding before you commit your money. If you found this video insightful, give it a like, subscribe for more financial wisdom, and drop your thoughts or questions in the comments below. Until next time, keep investing wisely.